Welcome to the 2015 Year in Review by Higgins & DeYoung Wealth Strategies. My name is Steve Higgins. Thanks for watching. So, you don't believe in Santa Claus either, huh? Well, investors did not get what they asked for Christmas this year. Year-end came and went with no gift of positive returns. December, it was representative of the entire year. A disappointment, with U.S. stocks finishing flat for the year. We hesitate to call it bad because bad can be so much worse. The technical term for 2015, well, it should just be lame. It seems all the scary headlines and fear were completely wasted. This lame market, well, it couldn't even go down. In July, we witnessed our first stock drop of over 10% since 2011, but investors were resilient and stocks came right back. However, investors seemed only confident enough to tread water. Only 4 times since 1929 has the S&P 500 finished within just 1% of where it began the year. So if you want to put a bow on 2015, consider this a gift. You are part of history. Well, any good year in review article should include some highlights and maybe some lowlights. So let's recap some of the stories that failed to move stocks in any direction. Interest rate hype. President Obama. Greece is broke. ISIS, Russia, oil plummeting, Chinese stocks were obliterated, Greece still broke, Donald Trump, terrorism, riots in Greece, riots in the US, the attacks in Paris, refugees, Deflategate, more interest rate talk, congressional budget battles, oil drops even lower, and of course, Greece is still broke. Oh, all of those memories. Well, we're 15 years into this fresh new century, and U.S. stocks, measured by the S&P 500, have returned only 2.6% per year. Nobody really uses 15-year rolling periods, but as it stands, it might be the worst 15-year period for stocks in a long time. Well, how in the world is that the good news, you ask? Well, since its inception in 1928, the S&P 500 has returned about 10% per year. If the first 30 years of this century turn out to be just average, the S&P 500 would need to return 17.4% per year for the next 15 years. That would grow $100,000 to about $1.2 million. If the returns for the first 30 years of the 2000s turn out to be 5% per year, just half the historical average, the next 15 years would have to yield a return of 7.4% per year. That would grow $100,000 to over $250,000. We know that time usually tells us that averages mean something, and they're made up of cycles. As unlikely as this may sound to you right now, we think you'll want to be part of this cycle. Well, true. Stocks, they've let us down and they've failed to meet our expectations. But have companies let us down? In the year 2000, still only a few people had cell phones, and those phones were basically just used for talking. Crazy, huh? On Friday nights, everybody rushed to the local Blockbuster video store to get their hands on the limited supply of new release DVDs. And nobody ever heard of Netflix. Only about 15% of Americans were online, and we used dial-up. The term Wi-Fi, that didn't really mean anything yet to most of us. Nobody could figure out how Google made money or what Google even was. And Amazon.com, they sold some books. Nobody texted. Apple was about to go bankrupt, and we used film in our cameras. And most people had a camera, and all that really did was take pictures. The first Tesla wasn't even on the road yet, and the first Toyota Prius hybrid vehicle was being sold in the United States. Nobody had heard of an iPod, and now those are relics of the past. Facebook's founder, Mark Zuckerberg, he was 16 in high school, and the first human genome was sequenced after decades of research and over $3 billion of investment. It cost over $100,000 to have your genome sequenced at the time, but only 20 people in the world had done it because of the scarcity of scientists and equipment. Now, you can have your genome sequenced for less than $1,000. In this new age of custom medical treatments, this is absolutely a revolution. If you're looking for a reason to look forward because it might be a little bit painful to look back, consider this. Technology breeds more technology. Better computers allow companies to make even better computers. And better computers allow scientists to do more research, and all of that research leads to the answering of questions and the curing of disease. For 15 years, we have been wowed by technology for the sake of technology. Now, as technology is deployed in every industry, new efficiencies are created and productivity increases. As industries find new ways to create and develop new products, companies make more money, and you as an investor are rewarded. Now, for those of you who contend we are in a stock market bubble and everything is overpriced, well, 15 years of less than 3% returns, almost 18 months of no stock market growth, and month after month of complacency, as statements at best look like the one from the previous month, doesn't sound like irrational exuberance. Over the next 15 years, there will be some rough times. There'll be a recession or two, maybe 3. There will be crashes in the stock market, and there will be negative years. But when you look back, will you have been part of progress and growth? And were you able to meet, maybe even exceed your goals? The last 15 years were not great. However, they were still positive. What will the next 15 years mean for you and your goals? Here at Higgins & Young, we don't do hype. We create powerful strategies that help our clients reach their goals. We would love to be your financial advisor. Check out higginsandyoung.com for more information. For all of us here at HD Wealth Strategies, I'm Steve Higgins. Happy New Year.